A very quick update for me, Economica, and I think you better start taking me seriously because I'm a LSE undergraduate, so I don't make up stuff. And as you can see, I have here a Taylor rule model, output gap model with UK ONS data. And what comes up to the eye is that from the chart is that the red line is the Bank of England bank rate benchmark, and the blue dashed line is the Taylor rule, which has been implemented in its classical form. And what jumped to me is that for many quarters, the benchmark was almost near zero, maybe 0.1 or a quarter of a percent, the bank rate, while the Taylor rule shows evidently that monetary policy was probably misplaced with respect to the business cycle. The real business cycle was the inflation gap or the output gap. And the second thing is that this big blue line here is that before and during the 2022 inflation shock, the Bank of England was late, because you see here that the Bank of England is hiking here, but it's 2 or 3 quarters late in hiking, was behind the curve, and eventually bank rates should have been hiked, Bank of England, Bank of Japan, Federal Reserve, ECB, around 10%, maybe a little bit more, but they couldn't do that. So, and now this Taylor rule has been implemented with the CPIH. You see that they are slightly below what should be the bank rate, and so there are two things that probably need to be clarified. So one, if R star makes sense, because the economy moves according to corporate rates or borrowing, so R star, for me, it doesn't serve any purpose rather than pricing what is sovereign debt borrowing. And if monetary policy has been misplaced for quite a long time, so if at this point actually indeed there is an asset bubble or not. So there are two main points of disagreement that I have. One, which is, there is an asset bubble or not. Two, is there any use R star because the economy moves with the corporate rate of borrowing. So let me know.